The Canadian mortgage process can be very complicated, and I'm here to simplify it. In Canada, we have many different types of mortgages, and lenders, and mortgage products, and I will break down 3 types of mortgages in Canada. Firstly, you have your A lender. Now, an A lender is someone like a big bank, so this could be Scotiabank or TD Canada Trust, or even a monoline lender. Now, a monoline lender, an example, is let's say First National, MCAP, RMG. Now, these lenders are only accessible through a mortgage broker. They don't have any bank branches, so if you're looking to visit someone face to face, Scotia and TD may be your best bet because they have bank branches everywhere. Now, a monoline lender, they don't have any bank branches and they operate online. However, they have really good mortgage products and they have very good portals as well, and they're very similar to big banks. And sometimes monoline lenders will give you an approval for a mortgage when a big bank may say no. Now, overall, to get approved with an A lender, you need verifiable income, good credit, and a minimum down payment depending on what your purchase price is. Next, you have your B lender. Now, B lenders are also large financial institutions as well, but the biggest key difference is they have a lot more flexibility. Your mortgage payments are slightly higher, maybe $400 or $600 a month more. However, that could be a difference of getting approved versus going with an A lender and not getting approved. So overall, a B lender has much more flexibility. They are not as strict with income, and a B lender is very good for someone who has bruised or damaged credit or is very highly leveraged. Now, a perfect example for a client that fits in a B category is someone who is self-employed. A self-employed individual is almost a great idea to fit into a B lender. Now, let's just say you're a plumber and you don't claim much income on your taxes just because you want to avoid paying any tax to CRA, or you want to pay a little bit less tax to CRA, so you maybe have more expenses that you claim on your tax return. Now, a B lender does not look at your T1s or your notice of assessments. They simply look at your business bank statements and they look at gross business deposits. So they will use 6 to 12 months of your business bank statements, and from those bank statements, they'll take your gross deposits and minus any expenses coming off of the bank statement, as well as any typical expenses you have. So if you are a plumber, for example, you will have, let's just say, a van that you will pay some cost to. So they will include that cost, and deduct that off of your monthly expenses. And that net income is actually used to qualify for more mortgage money. Now, a B lender is more expensive because there are fees involved, typically a lender fee and a broker fee. However, sometimes it actually makes sense to stick with the B lender because you will pay less annually in mortgage interest than you would pay to CRA for taxes owing. So a cost analysis needs to be done to see if it makes sense. And a B lender is a short-term solution. You want to stick with the B lender for 1 or 2 years and then refinance or have a game plan on how to refinance and get back over to the A lending side, because long-term B lending can be very expensive. However, like I said, you got to do a cost analysis because you got to see how much tax you will be paying long-term versus how much you'll pay in interest to a B lender. So a cost analysis has to be done, and the benefits need to be weighed and the pros and cons also need to be compared. Lastly, you have your private lender. Now, private lenders are very expensive. They're for highly leveraged investors, maybe more experienced investors. They know that there's a cost of doing business. They have no other option. Perhaps they'll pay $50,000 to a private lender. However, their project or the return on that property might be $100,000. So a cost analysis again has to be done. But a private lender is for someone that's highly leveraged. Let's say you have bruised or very damaged credit and you will need some time to repair your credit, or you might be new to Canada with no credit at all. Also, a private lender is very good if you own a home and you have a lot of high interest debt. For example, you might have a credit card at 20-25% interest. It might make sense to keep your first mortgage as is. You don't want to break that first mortgage because maybe you're locked into a very low rate or there might be a high penalty involved. And you actually take a second private mortgage to reduce the overall interest paid. So instead of you paying 25% or 20%, it gets cut in half. And long term, you're actually able to reduce the interest amount paid and overall reduce or eliminate any debt you have. Now, private lending, like I said, is very expensive. Rates are as high as 7% and above. They are purely equity-based lenders. So the private lenders are actually looking at What's your property looking like? Are there any damages to your property? Is your property marketable if it needs to be sold? So they don't care about income. They don't look at any income. Sometimes private lenders do care if you have any taxes owing to CRA, and if you do, they might want those paid off. Or some private lenders don't even look at that and don't care, but they do want a good appraisal report and to make sure that you have enough equity in the home that you're buying or the home that you are refinancing. I hope this video clarified many of your questions. If you would like to get pre-approved, would like a second opinion, or would like to see what's going on in the current mortgage market, please feel free to book a free 15-minute discovery call and we could definitely see how we could assist you. We look forward to seeing you at our next video and providing more valuable insight on the Canadian mortgage industry. We look forward to seeing you at our next video. Please don't forget to subscribe, share, like, comment, as it does help our channel quite a bit. We'll see you next time.